And there we go. Buy-sell agreements webinar is live. Welcome everybody to, as I said, to buy-sell agreements, the last say on your business. For those of you who don't know, my name is Sean O'Rourke. I am a cyber liability consultant and business development head at Combs & Company, which is an insurance brokerage firm and consultancy headquartered in New York City. And in just a moment, I'm going to let the two panelists introduce themselves, and then we'll get right into the crux of this presentation. But just for general housekeeping terms, we do want to keep this open to you. In case you have questions during the webinar, feel free to use the Q&A. I will be monitoring that. You are more than welcome to post your questions there. If the Q&A function is not working properly for you, or you have a difficult time figuring out where it is, you may use the chat, but please restrict the chat to just me. And then I will present the questions to either Adam or Todd as we go through the presentation. Toward the end of the presentation, I will put both Adam and Todd's email addresses into the chat window for everybody to have in case you want to follow up with them and drop them an email, especially since while we've been promoting this webinar for about a month, Todd has made a move, so his email address changed from the original one. So I want to make sure everybody has his latest and greatest so you can get in touch with him. And without further ado, Adam Russ, why don't you introduce yourself and tell the fine folks who you are and what you do.
My name is Adam Russ. I'm a partner at the law firm of Wasser and Russ. My focus of my practice is commercial litigation with experience dealing with partnership and shareholder disputes in closely held businesses.
Excellent. Todd, your turn.
Hello, everyone. Thanks for joining us. My name is Todd Bass. I am part of the advanced markets and business planning team at Mass Mutual. My partner and I work with closely in privately held businesses, family-owned businesses, and implementing advanced strategies to help with tax mitigation, succession, and continuity planning, and the passing along of ownership in amongst privately owned businesses.
Excellent. So one of the primary reasons why I have you both on is because I've actually had extensive working experience with both of you, Todd, as well as your partner, Greta, in various elements of either law or insurance. And today's topic actually dovetails nicely with both of them. We're going to talk about buy-sell agreements. And Adam, you get to go first by just telling everybody what a buy-sell agreement is.
So there is no readily available public market for the purchase or sale of interests in closely held businesses. So when the shareholder or member owners of the business want to sell their interests to the remaining shareholders, or when a group of shareholders of a closely held business want, because of some triggering event, to get rid of a owner of the closely held business, the buy-sell agreement is an agreement. Sometimes it's a standalone agreement, and sometimes it's a clause in an operating agreement for an LLC or a shareholder agreement for a corporate entity, whereby the parties agreed in advance how those transactions are going to occur, when they are going to occur, to facilitate the buyout of a shareholder or member of that closely held business. So that's what a buy-sell agreement is in a nutshell.
So it's advanced planning for somebody's exit, whether voluntary or involuntary, from a business partnership.
Yes, one of my colleagues calls it the last will and testament of a closely held business.
And we cribbed that by saying the final say on your business. So that's very much akin to that. So since you said it's a partnership sort of agreement, does this mean solo entrepreneurs need buy-sell agreements or no?
So a solopreneur, meaning a one owner business, would not need a buy-sell agreement. But and this is a big but, if the solopreneur is anticipating or planning to bring partners on, my suggestion would be to have a buy-sell provision incorporated in their governing documents so that when they bring that additional member or shareholder into the fold, there's already a framework, there's already a clause that would govern. That could potentially minimize negotiations or discussions about what the terms of a buy-sell are going to look like. And that would give the solopreneur a little bit of more leverage in having the terms be what they want them to be before they even bring other members or shareholders into the fold. So it's absolutely not necessary. And let me make something clear. Under New York law, a buy-sell agreement, it's not required. This is not something that's required by law. But those that go without one do so at their peril.
I will add this, right? And while a solopreneur may not need the buy sell without having any existing partners, whether anticipated or not anticipated, there is an element to the business planning side where a solopreneur can have something called a one-way buy sell agreement between themselves and their estate. And the benefit to doing that is they can insure themselves for the full value of their business, so that if in the event they experienced either an unanticipated death or became disabled and were unable to work, rather than having to sell the business at a severe discount on the open market, knowing what the situation was, their family, their estate, they would receive the full value through the insurance planning, and then would still have the ability to go and sell the business on the open market for additional capital.
Well, and that brings up a good point, because Todd, you are a recovering lawyer who entered the insurance world. And so from your perspective, both obviously you understand the legal concepts as well. But from an insurance perspective, if you don't have a buy sell right at the beginning, when do you recommend that business partnerships, business owners get the buy sell in place, if it can't be at the very beginning? Let's be honest.
So I would say, as a solopreneur, you have a little bit more latitude as to when you want to really sit down and implement a one-way buy sell potentially. When there are partners involved, and I think Adam will agree, tomorrow is never promised, and we don't know what is around the corner. So if you have a business and you have at least one other partner, the best advice I can offer is to sit down and take the time and spend the money to do some form of agreement, right? Because without an agreement in place, the only thing you're asking for is litigation, right? And these agreements and these buy sells don't necessarily have to be these expensive agreements or clauses. They can be set up in a way where it's very straightforward and inexpensive, even to fund it on a low level in the beginning, where you might be tight for cash or there might not be an abundance of cash flow. You can still put something in place to properly protect and insulate both partners, or as many partners as there are, without getting too far out of control, and then kind of putting that off until the later years.
And we'll talk about the funding piece of it and what that all means and how you go about doing that down the road. But Adam, to Todd's point, you've obviously done numerous buy-sell agreements. You were involved in one that was very personable to me, and a transaction on that front. Give us a general sense. Todd said the word litigation. Give us a general sense of what you've seen in reality, what happens when there is no buy-sell agreement, or a buy-sell agreement that you tried to crib together from stuff that you found on the internet.
Well, so no buy-sell agreement, or a buy-sell agreement that was put together by people that don't know what they're doing, or really didn't use things that were appropriate for the situation they're in, is great news for the lawyers, but only for the lawyers. A buy-sell agreement, like any other agreement, is really just a roadmap for the parties. If they cannot sit down and negotiate a reasonable alternative. It's basically two business owners. One decides they want to retire and says to his partner, we have this buy-sell agreement. We did it 20 years ago. I don't think it's really reflective of what the true value is today. Would you pay me X and I'll walk away and I'll give you 2 years before I retire? There is nothing preventing the parties from at that moment modifying whatever the buy-sell that's in place. But the purpose of the buy-sell is if the non-retiring partner says, no, that's our deal. You want to retire, that's the deal. And those are the terms I'm prepared to go forward with. They revert to that original deal. When there is no buy-sell agreement, you have to go to court to figure these issues out if you cannot amongst yourself figure these issues out. The issues you're going to have to resolve is, what is the price? What is the value of the retiring shareholders' ownership interest in the business? How is that price going to be paid? Monthly, quarterly, annually, over what period of time? Those are the issues that would have to be resolved within the context of either a negotiation or a litigation. And sometimes those litigations, the reality is, can wind up costing people more than the actual value they are ultimately fighting about. By doing a buy-sell agreement, you take all of that uncertainty and that cost out of the mix. And something I like to tell clients when they're in the setup or organizational phase of a new entity is, I view this very much as a pay me now or pay me later. Pay me later, it's going to be more complicated, and you're not necessarily going to get the cleanest result or the result that you could probably get today if you spent the time, the energy, or the money. A lot of business owners, in my experience, particularly at the beginning, are overwhelmed with the number of issues that they're dealing with, setting up the entity, financing the entity,
The right tax election,
taxes, employees, if they're in the manufacturing business, manufacturing issues, if they're in a service business, providing the services that they provide. So there are a lot of issues. And sometimes these discussions, much like when you're planning a last will and testament, these are not easy discussions. These are difficult discussions. These are discussions that could cause partners that are on the same page on how to run their business to not necessarily be on the same page as to what their equity interest will be worth someday in the future, or what events would trigger a mandatory buy sell. And how do we value the business? You know, you and I, Sean, may have a very different idea about how to value a closely held business. There are tried and true formulas and clauses as to how to value things, but those tried and true clauses, they don't always apply. They don't always make sense given the circumstance. And those are the kinds of discussions that I found business owners tend to be resistant. They just want to get the business running. They want to get the business set up. They want to get dollars coming in, and they'll worry about the other stuff later. Because, a business owner, they're not worried about becoming disabled. They're not worried about dying, getting divorced. They're worried about getting the business going.
Sure.
And that's usually where the the occurrence or the fault happens is, and we see it so often in our business, owners and partners and shareholders are so caught up in getting the business going and off the ground and making it profitable that, before they realize it, they're so indulged in that they forget to address setting the foundation of the buy sell, right? And to Adam's point, a lot of these things can wind up being extremely costly just going back to the point on valuation, you could have multiple partners or even two partners who have completely different perspectives on what the company is worth or even how to value it. And what we've seen is the easiest way to avoid that conflict and have that blueprint or the roadmap that Adam referred to was to set forth in that agreement. This is how we're going to do an annual review of the valuation. We're going to value it based on whatever formula we agree or decide is fair, whether it be enterprise value or some industry multiple of EBITDA or book value, whatever it may be. But having that laid out and following that agreement on an annual basis and doing that review will keep everything fresh, right? You could have a valuation that was done 5 years ago, but if something comes up or there's a triggering event like Adam referred to 5 years later, that valuation is now stale. And now how do you reevaluate it?
Well, and then let me throw this question out to either one of you because you've both been involved in it. What does a buy sell or should a buy sell? Let me put it to you that way. What should a buy sell address on a very basic level? Because I know when we had the prep talk for this webinar, you two kept going back and forth. I mean, there were so many potential scenarios that we could have been here for a year just on the potential scenarios that a buy sell could address. But really on a base level, what should a buy sell address? And Todd, start with some of your thoughts, and then Adam, you'll get to close it out.
Yeah, so I think on the most fundamental level, there is, right, death and disability become the first two that come to everyone's mind, right? If a partner passes away unexpectedly, how is the business expected to recapture that deceased partner's equity? Unfortunately, people get sick. There's this terrible thing called cancer and other diseases out there that will prevent people from working. And if someone becomes ill and can't work anymore, well, how do you buy out that partner? So I think death and disability become the first two, but then Adam and I'm sure can exchange and volley back and forth. There are these things called triggering events, right? And death and disability do constitute or fall under the definition of a triggering event, but there's also, let's see, there's dissolution of a marriage. There is loss of a professional licensing. Adam, what else? I mean, there's
Bankruptcy.
any number. Bankruptcy.
Personal bankruptcy, right?
Personal bankruptcy by the owner.
Criminal conviction. I mean, I think that you could kind of sit and go back and forth all day about all the things that could go wrong that would trigger or serve as a triggering event. But at the end of the day, I think that whoever the partners are need to sit down and say, what directly affects us? What directly affects our industry? You know, your triggering events for two law partners may be very different for two triggering events of partners that own a bakery, right? Two owners of a bakery aren't going to worry about the loss of professional licensing. Two lawyers, however, have to address that because if one partner loses their license for unethical acts and can't any longer practice, then they bring no value to the business anymore. So
not only do they bring no value to the business, they are legally not allowed to be a member of a law firm,
correct,
an owner of a law firm if they're no longer licensed.
Triggering events, I think, is a very broad term. And it's something that needs to be addressed on an individual and subjective basis. But it's literally the pulse of your business. If something is to go wrong, what is going to mandate, what's going to require the exit of one partner or the repurchase of their equity?
So to that point, Adam, then are buy-sell agreements written to the particular industry that you're doing it for, or are they written in, I don't want to say boilerplate, but again, in a general fashion, and then you refine based on industry? Because obviously, if there could be so many potential triggering events, not all of them are pertinent to, let's say,
sort of like
my old IT firm as opposed to a law firm.
It's like a custom suit.
I think that there are some triggering events that are totally industry agnostic.
Mhm.
Death, disability, retirement, bankruptcy, divorce, doesn't care, doesn't matter what industry you're in. I think the industries where you have to have more in-depth discussions about triggering events are the industries that are highly regulated, require licenses, things of that nature. So we're talking about medical practices, law firms, maybe to some extent accounting firms, if CPA licenses are involved. But I really think that, the basics, the ones I mentioned at the top and that Todd mentioned a few minutes ago, those go, into every agreement. I think there are some other things that, if you think about, may or may not apply depending on the industry you're in, and like bad press, things that bring you into ill repute. If you're a public figure or you're dealing with a public nature type of a business, that would be a very specific type of a triggering event for a specific type of a business, which might not be necessary in a bakery or in a
car dealership or anything.
A car dealership or anything, where, if it was something that was a little more out there and in the public eye, that might be more applicable. That's not to say you couldn't have that type of a triggering event in any business. Two bakeries and one guy gets a bad review on a TV show or something, and maybe that bakery, the other bakery owner, wants to be able to trigger a buy sell for that. But that's the kind of discussion that could and should happen with the lawyer preparing the buy sell agreement right at the beginning.
Well, and I want to take a moment, because these triggering events, death, disability, are obvious. The one business partner is no longer available, so there has to be some sort of mechanism in place. Okay, they're no longer available, so what happens to their share, their votes, or what have you? But let's take divorce. Why do you need something to outline if one of the business partners gets divorced? How does a divorce potentially affect a business?
It's very simple. So, Sean, if you, Todd, and I set up a company, and then you go through a messy divorce, and in that divorce, your ex-wife is awarded 50% of your interest in the business that you, Todd, and I owned. Todd and I never agreed to be partners with your ex-wife. Todd and I do not want your ex-wife having one vote or half a vote of anything to do with the shareholder, with the running of our business. So what a buy sell divorce triggering mechanism would say in that situation, you would have to sell at whatever the agreed rates were, either to the company or to Todd and I, and we would buy out that 50% share or all of your share in the business in order to, it would also, from your perspective as the one going through divorce, set for you how to evaluate what your interest in the business is worth, so that you could turn to your ex-wife and or the court and say, look, if she gets half of my interest in the business, I'm forced to sell it to the business for X dollars based on the formula we agreed to. I will give her, on the same terms, that money in lieu of the shares in the business, because otherwise the shares are going back to the company or to Todd and Adam. So to me, and I've seen this too many times in the real world where there was no buy sell agreement.
Yep.
A divorce of one or more of the owners of a business can literally wipe a business out.
Yep.
Because small, closely held businesses, culture is a very, very important part, and adding somebody to the mix that was never part of it and never intended to be part of the business can really cripple the functioning of a business.
Well, especially if there was acrimony in the separation that brought that new partner in. So
yeah, but even in an event where it's not necessarily acrimonious, I get along with you. I decided to do business with you. I didn't decide to do business with your wife,
Right.
your wife or now ex-wife or
widow.
I apologize in advance, Susan. I'm speaking figuratively, not literally. But I didn't agree to go into business with my business partner's spouses.
Right.
That's not what was expected or anticipated. So using the divorce as a triggering event protects not only the shareholder going through the divorce, but it protects the shareholders or members of the business that aren't going through it from having to be saddled with a partner they never agreed to, they never wanted.
And the same theory really applies to the death as well, right? If you have the death of a partner and it's not specifically laid out how the shares will be recaptured by the business, Adam and I may not like your children, and now your children are unfortunately our partners. So, with respect to the death of a member, there's usually terminology or language in there that'll set forth if, God forbid Sean dies. I'm not wishing it on anyone, but if one partner passes, if one partner passes away, automatically the shares will revert back to the company at X value or based on whatever valuation the partners had agreed to before that.
Well, that's a good segue. Well, first of all, let me jump in here and just remind everybody in the audience, if you have questions for the panelists, feel free to drop them in the Q&A. I'm keeping an eye on there, or you can send me a message via chat, but please only send it to me. And I'll pass the question along. So let me ask you, and Todd, this is where your current area of expertise sort of jumps into play. You talked about funding a buy-sell agreement, and it's a fairly ubiquitous term when it comes to the buy-sell agreement, but it doesn't necessarily explain what all the mechanisms are in terms of funding, because the triggering events could be so different: death, divorce, disability, potential legal ramifications, bankruptcy, and whatnot. So there's the term funding. So why don't you explain what it means to fund a buy-sell agreement, and then we'll talk about all the different ways that plays into some of the triggering events that we just discussed.
Sure. So when you have this triggering event that has now occurred, the triggering event and the operating agreement require the remaining partners to then repurchase or recapture the equity from whoever the partner was that either became deceased or disabled or retired. In order to recapture that equity, there has to be some sort of liquidity available to the business to purchase back the equity from that exiting partner, right? And typically, companies will have some excess cash flow and reserves. But when you're talking about equity in a closely held business and that business has been stabilized and in existence for several years, the value has substantially increased. And typically, we don't see companies with enough free cash laying around on reserves to be able to repurchase $3 or $4 or $5 million of equity from an exiting partner. So in terms of funding, it's sort of like creating a kitty or a rainy day account for when a partner does exit. Where is that money going to come from in order to repurchase their equity?
And so what are some of the most obvious one is death. So how are you going to fund the death provision in a buy-sell?
There's really three historical ways to fund a buy-sell, regardless of what the triggering event might be, right? The first and the most obvious and available one is a drag or a revenue reduction, which simply means that the remaining partners would use some agreed upon portion of their revenue or their net profits to pay the estate of the exiting partner to recapture their equity. And it usually winds up in some kind of installment repurchase, meaning they'll pay out the estate over X amount of years until 100% of the equity on that partner is bought back. It's not necessarily the most financially efficient way to do it, because in terms of equity to dollars, you're going to be paying a 1-to-1 ratio. And what that really means is that if the three of us each have $5 million of equity in our company and you become deceased and we use a revenue reduction, we're going to pay you $5 million to recapture your $5 million worth of equity. The other option is obviously to go and get bank financing. The financing actually becomes even less efficient because you're still paying that same 1-to-1 ratio, but now you have to introduce interest rates and cost of
yeah.
capital and the payments on top of that. So now you're actually paying more than the 5 million to recapture the 5 million of equity. The third way, which most people don't even really know about, is that you can actually fund a buy-sell agreement with a permanent whole life insurance policy. And the reason a lot of companies will do this is, going back to the $5 million hypothetical, if each of us has to get $5 million of coverage in order to buy back the entirety of the equity, that 5 million of coverage, and it was interesting, I was curious to see myself what this would run. The 5 million of coverage over I think it was a 15-year period, would wind up costing around $2.3 million in actual dollars laid out, which means that the $2.3 million of premiums paid over 15 years would be able to buy out that full $5 million of equity. So in essence, what business owners are able to do with this permanent life insurance is buy back 100% of the equity at an organic discount without devaluing the exiting partner's equity.
And so to use a real world example, when I was a partner in my IT firm and decided basically to retire from the day-to-day of dealing with people's IT, we had a buy-sell agreement in place that helped us come to a number. But if I was deceased, we had term life insurance on all of us. 20-year term life insurance on all of us. So it was $1 million is the way we had done it. And that was going to be the way that we had funded, because we didn't want to do a whole life because it was too expensive when we were doing it, because we were funding it very early on in our business and we had a service business. So we weren't dealing with, at that point, incredible margins. And so to that end, we decided to do the term life insurance because it was a cheaper option, but still gave us that exit capital that you talked about.
And to your point, Sean, in the very beginning or in those early stages, the term insurance really is the most efficient way to do it. And you had asked me earlier, when should partners really set up a buy sell? And the true answer is on day one. And if there isn't enough capital to fund a whole life policy to fund the buy sell, then use the term. And if you're not sure if you're going to stay in the business for a long period, a 10-year term policy for $1 million could be anywhere from $100 a month. But you understand that you're putting the safeguards in place that if God forbid something were to happen, that buy sell is now at least funded. If you get later on in the business and the business has become abundantly wealthy and has excess cash flow, then the whole life policy can be entertained. The nice thing with the whole life policy is, for the people that don't know, is these whole life policies have cash value components to them.
Right.
And those cash value components can be tapped into for any reason whatsoever. So it doesn't only have to be death or disability, but like you said, Sean, if you were to retire with a whole life policy, that cash value is built up, the company can then tap into that policy and use the buildup of cash to purchase your equity back and buy you out. So,
but that won't work. So a whole life policy won't work for disability. So you need a disability policy. But how do you fund, let's use Adam's example of divorce. How would you fund the divorce then?
So you could simply just use a whole life policy and over the years.
But let's say you don't build up enough capital, enough cash in that whole life policy.
Then some of that money is going to have to come out of either earnings. And another thing that I've seen in these agreements is at the start, the company agrees, the shareholders, the members agree to take 10% of all earnings and stick them into an account for this eventuality. It's not necessarily an efficient use of money. And things could happen, which they always do in business, where you have an unanticipated large expense that you have to deal with. And members might be tempted to dip into those cash reserves that are supposed to be there for the rainy day of a buyout and use them. And depending on the agreement, if you had majority or unanimous agreement of the owners to dip into that money, well, now the money's gone, but you can't insure for every triggering event, correct? A whole life policy does allow you to build up cash value, and to the extent you can use that cash value to fund any triggering event, great. But I think there's always going to be the possibility and the element that you are going to wind up having to use some current and future revenues to fund the buyout. That's just, yeah, to some extent. And so what the insurance does, potentially, whole life, is for the non-death, the non-disability, the non-insurable things, it allows you to hedge how much of that you'll have to dip into if you've built up sufficient cash value.
So, quick question. Can a buy-sell agreement dictate how much the business has to put in to, let's say, funding the buy-sell agreement? So I know mine dictated that we had to have life insurance on all of us and disability insurance.
Yeah,
but it didn't say anything that we had to put money away for a potential rainy day and whatnot. But could a buy-sell dictate that?
Yes,
Absolutely.
a buy-sell could say the company's going to take 10% out of all gross revenue, and they're going to stick it into an account, which is, for this purpose. It could be $2,000 a month, pick a number. You can agree as long as it's not illegal. And there may be significant tax reasons to do it in a certain way or to not do it in a certain way. And this raises an issue that, it's very important when you're having these discussions and you're setting up these things to bring in whoever your tax advisors are, be they accountants or tax lawyers. I am not a tax lawyer. I am not an accountant. I don't play a tax lawyer or an accountant on TV. I do not give tax advice. I do not pretend to give tax advice. The only advice I give is, let's get your accountant involved. Let's get your tax lawyer involved. Or if you don't have one of or both of those things, I have resources that I can introduce to the client and say, all right, should we do it this way or that way? What's the more tax advantageous way to do it from? And interestingly enough, depending on the type of entity, whether it's an LLC or a corp or an S corp, may dictate which ways are more tax advantageous for the owners and or the business. And so these are very, very situation specific discussions that have to happen. There's really no one size fits all situations on the tax side of things.
And I do want to add just one thing, and this is just something that Greta and I had actually worked on recently from a tax planning perspective. Is there is a section in the code under 162 of the revenue code. Businesses can bonus the owners and executives with life insurance policies and use those premiums paid as full tax deductions. Now, normally those policies would belong to the executives, the owners, the partners personally, but within the operating agreement or the buy-sell provision, the owners and partners and shareholders, really only the shareholders because it applies more to corporations, but the shareholders can agree to use the cash value in their personal policies that the company is paying for to fund one of these triggering events as well.
Gotcha.
And the company still actually is able to capture the tax deduction as a benefit.
Sean, it looks like we have a hand raised in the audience.
Yes, Lisa Horowitz. So Lisa, if you could just enter your question in the Q&A or just send it to me in the chat, and I will be sure to pass that along to Adam and Todd. I don't want to open up the webinar to questions just yet, simply because of I want to make sure that we keep the flow going. So I'll be more than happy if you just want to send it over to us to submit that. So let me move on to I have all my questions down here just in case. So you have the agreement in place. You wrote it in, let's say, the second year that you were in business because you finally had some time to focus on it, but really all you focused on was the four most obvious precipitating events that you could address. But 6 years later, things have really changed. The business has grown. One of you has gotten married and had some kids. And so their situations are changing. And in that regard, can you change buy-sell agreements? And does it have to be unanimous to change these?
So I'll take a stab at this. You can always change buy-sell agreements. Typically, the buy-sell agreements are part of either a shareholder agreement or an operating agreement that governs the management, operation, and voting for the entity. So within that shareholder or operating agreement, there could be different thresholds for changing certain items in those agreements. So very often, these types of decisions like buy-sells, the owners would want changes to that clause or that section to only be by unanimous consent of the owners. But it could be, a super majority or a majority vote. I mean, that is really up to the owners. And that's, again, I don't think there's a one size fits all solution. My thinking is that, unanimous consent with 2 owners or 3 owners is one thing. But if you have more than 10 or 15 shareholders, owners, that's when I think it would be more likely you'd want to consider or start talking about a majority vote or a super majority vote for these types of changes. Again, there is no requirement under New York law that you have to have these agreements, these buy-sell agreements at all. Likewise, there is no requirement under New York law as to how and when you can change these agreements and what you can provide in them, so long as what you provide is not against the law.
Right. And just, we've seen a couple of times you have partners or shareholders who put off doing the buy-sell or even an operating agreement or shareholder agreement because they don't feel they're ready. These agreements can literally be amended and ratified at any point in time, going back to what Adam said, just depending on what has been set forth or dictated as what constitutes a unanimous or deciding majority of the vote. So you can always go back 5, 10, 15 years down the line, decide, hey, something happened last year. We didn't like the way this took place. We want to go back into the operating agreement of the buy-sell, and we just want to make that revision. That amendment can be made as long as it's ratified by the partners or the shareholders. It'll take effect and go into effect immediately.
Much like estate planning for individuals, there are normal, natural times that buy-sell agreements should be dusted off and looked at. And Todd mentioned this. There are, and I've seen many agreements which require an updating of the valuation, which with whatever mechanism is chosen, every year, every 5 years, every 10 years. But think about the lifespan of a company. When a company goes through ownership changes, when a company goes through significant growth in business, in assets, those are the times that the discussions, does the plan we put in place 5 years ago, 3 years ago, 10 years ago, does that make sense? I mean, I'll give you an example of one that just I had some dealings on, where we had 3 owners of a law firm, and they were bringing in a 4th partner, but that 4th partner was bringing to the table a really substantial book of business, and said to the 3 existing partners, listen, the only way this works for me is if we reconfigure the buy-sell agreement to reflect the significant value I'm bringing to the table. And that's a discussion they had, and they were able to work out an agreement that completely scrapped the existing buy-sell agreement in their partnership agreement and reconfigured it to reflect the post-merger realities. Those are situations where I would say to you, even if the new partner doesn't come in making those kinds of demands or suggestions, that's when the existing partner should say, all right, we're adding a new partner, a new member, a new shareholder. Let's take a look at our buy sell. Let's figure out, does this still work for us? Does this still make sense? Is the mechanism we used for valuing, the formula, does that still work for us? Another example is like in the real estate business. I've seen situations where originally they just based it on the most recent appraised values of the properties, but that doesn't really reflect what the value of the business is, because the value of the business to some extent became more of a cash flow thing than the appraised value of the properties being held. I've seen situations where the parties agreed that each side would pick their own appraiser, and then those two appraisers would select a third appraiser. And if the two party appraisers were within 10% of each other, you'd take the middle number between them. If they were more than 20% apart, they would pick a third appraiser, and that appraiser's opinion would be final as to what the value is. I mean, there's a million different ways you could do these things. And again, you can be as creative or as simple as you and the team putting it together want it to be. And I think I said this to you when we were prepping. I would rather see a business with a very basic buy-sell agreement that doesn't necessarily have all the bells and whistles than no buy-sell agreement at all. Because no buy-sell agreement at all, and one of these triggering events occurs, it could end the business, because it could make things so dysfunctional and literally nobody would get what they want or what they deserve.
And I just want to piggyback on that also is, there's an element of quality in addressing your buy sell. I have seen more people than I care to remember who have said, well, I did my buy sell through LegalZoom or Rocket Lawyer. And I'm not knocking LegalZoom or Rocket Lawyer. They do work for certain things, but a buy-sell agreement or an operating agreement between two partners is not the thing that they should be doing, because those agreements are very generic and boilerplate. And based on what Adam just said about tailoring it and the comment I made a little while ago about how it can be a custom tailored suit to fit the needs and specifics of what the two partners or however many partners are looking for, this isn't something that you want to go to LegalZoom or Rocket Lawyer for. This is something that you want to sit down with an attorney such as Adam or whoever and kind of go through all of the potential issues that you may face and have that drawn up the right way. The funding can be kept minimal. The drafting is really the core, the essence, and the foundation of that agreement. You can always go back and amend and ratify, but to do it through Rocket Lawyer, LegalZoom, or any of these online legal providers, in my mind, you're doing yourself an enormous disservice. You're much better off spending a little bit of money now to put in place, like Adam said, just a fundamental buy-sell agreement and having it be done correctly, rather than having to go back later and say, gosh, we really screwed up. This agreement we got from Rocket Lawyer didn't touch on any of the things that we're going through now.
Well, and go ahead, Adam.
I think, a fundamental part of the process is having the discussions and knowing what questions should be asked. And by using, a lawyer that's done more than a couple of these and seen it from both preparing the agreements to what happens if you have a lousy agreement or you have no agreement at all, what does that look like? I think, that kind of a professional can help ask the questions and put out there the issues that should be considered and discussed by the business owners, so that they walk away from the process having an agreement that will work and will stand up if or I should say when one of these triggering events occur. Because in the life of a business, these triggering events, they always occur. It's really just a question of how they're dealt with. And the ultimate failure is when a triggering event causes the end of a business.
Yeah.
Right. And that's what I was, you sort of said exactly what I was going to say, is that if you find an experienced attorney, they could be your cheat sheet on how to put these together because they've done it before. So they could tell you, okay, you're a real estate company. Outside of the most basic ones or the most obvious ones, maybe you consider this. If you're a law firm, consider this. If you're a manufacturer, consider this. So I think that's one of the key takeaways from this whole discussion is that, look, you yourself as the business owner can continue to focus on the business as long as you find an experienced representative to help you draft this buy-sell agreement. You will have to put in some work, but you don't have to do all the foundational elements because that experienced attorney could probably do a lot of that for you. You just have to fill in those very specific areas as they relate to your business and what you expect that business to do, let's say over the next 5 years. Because let's be honest, you really can't foresee more than a couple years in advance. And I mean, if you ask people in February of 2020 how they foresaw the year going, it would have been a much different answer then versus 30 or 45 days later on that front. So to that end, we are at 52 minutes. And I think we've covered all the bases. If anybody out there has a question, any of the attendees have a question, now's the time to throw it into the Q&A or to the chat box, and we'll get it to the panelists. But if not, while we're waiting on there, why don't you both give me sort of final thoughts on this, that if there's somebody out there who's advising a client in some regard, and whether it's a business owner themselves or they're advising business owners or whatnot, give me a takeaway from today that they should know about buy-sell agreements and what they should be doing with them now.
So, you know the saying, people plan and God laughs, right? so in my world, people plan or they fail to plan and litigators laugh.
Very true.
I think and I believe that an ounce of prevention is worth, a pound of security, and safety and stability. And if you are in a position where you are starting a new business and you're doing all the things necessary to start a business, I don't care how thin or thinly capitalized you are, you have enough, and you should be thinking about, if there is more than one owner, putting in place a buy-sell agreement, which will map out what happens competently in the event that a triggering event occurs. And if you do not, you are basically asking for a litigation or a failure of the business.
Right. And I'm going to go one step further. If you even think that you're going to start a business, right, in budgeting for what you will need to start that business, please include the cost of setting up your operating agreement and buy sell, and make that as important as whatever inventory you need to stock up on. Make it as important as the website that your company is going to have, because like Adam said, without it in place, you really are, you're playing Russian roulette with a loaded revolver, and not having it in place can lead to disastrous outcomes, which ultimately could mean the end of the business.
Well, that's salient advice that I actually took to heart when I was a partner in an IT firm, and because we had a pretty extensive buy-sell agreement, thank you, Adam, for that, it made my transition out pretty smooth. There were really no negotiations except on the valuation, and it was all done within a few months, and went down as easily as possible. So I am a living example of how a good buy-sell agreements can make your life easier, while maintaining for the business partners who are still running the company, making sure that they're protected and that the company can continue even while you're off doing something else, like hosting a webinar about buy-sell agreements. Hey, go figure. Anyway, hey, Adam, Todd, this was fantastic. Todd, your partner Greta just set us up for a nice T-ball shot in that, yes, we will be doing future webinars on topics that touch on business ownership, how to protect yourself, how to protect the business, how to help you get out of the business, help you retire, so on and so forth. Those will be coming down the road. You will get updates as they go along. But as a reminder, this was a recorded webinar, of which I will stop momentarily. So be on the lookout for Adam, Todd, or my social media, and you'll be able to get a link to the recording of this video. Feel free to pass it along to folks who might not have been able to attend, who might find the information contained therein interesting. And you'll also be able to reach out to Todd or Adam to talk to them about your own buy-sell questions or your own buy-sell situation and how to remedy something that might not be fully in place for you. So for Adam and Todd, my name is Sean O'Rourke. I want to thank everybody for tuning in. And until next time, gentlemen, you guys take care.
Thank you, Sean.
Thanks for having us, Sean.
Thanks, Todd.
Pleasure, Ab.